Now you might say that, well, we can't introduce FTTs, they're too complicated and so on. Not true. FTTs exist already. If you've got a credit card and you go to a foreign country, using a foreign currency, and you buy something, you will see that your credit card statement will typically include a charge of around 2% in France. In the UK, the charges are even higher, going up to typically between 2.75 and 2.99% on most cards. Although, interestingly, there are a few cards that don't charge anything at all. There are 6 out of 250 odd different cards available in the UK which don't charge a transaction fee at all. So they don't have to do it. They just charge it because they can get away with it. Here's my I've got an ONI card in France, and you can see here, this is what my statement looks like when I bought something from Amazon Co. UK for £102. I got charged to 122 euros plus a €2.58 frais transaction fee, which is 2%. With my BNP corporate credit card, it's even worse. These are some transactions I did in the States last year. You can see the amount in euros within brackets, the transaction fee, which goes up to 6.61% when I bought some $21 of gasoline in a petrol station. The reason is because they have a 70 centime flat rate tax plus 2.2% of the value of the transaction. Now this is a pure financial transaction tax. It's not you being used to pay for the credit card system. That's already paid by the merchant who has to pay something between 2 to 3% on every transaction in order to be able to get the system to work. This is just for multiplying the value of the thing you bought by the current exchange rate. It's totally unjustifiable. Banks do it because they can get away with it and because people don't notice. Even 2 or 3% people don't notice. So it's just not true that an FTT would cause problems, because we're already doing that when we buy things abroad. And interestingly, if that 2% rate was applied to the $1,200 trillion handled per year in foreign exchange transactions by the CLS banking system, that would generate something like $2.4 trillion a year in revenue. So just applying the same rules that the banks apply to ordinary citizens when they change currencies to the financial sector changing currencies would generate absolutely colossal amounts of money worldwide. I've sort of pointed out that most of the ideas that I propose were already in Edgar Fieger's proposition in 2000. Actually, I do have one new feature which I think is well worth thinking about. It's the idea of having a variable rate financial transaction tax, one in which the rate is actually not fixed but varies continuously to guarantee that revenue matches expenditure. It's actually a way of implementing what in France we call the golden rule, the idea that we should match government revenue to expenditure. So, for instance, in France, the government makes 817 billion euros in revenue from taxation. That's 68 billion a month. Total transactions that we've seen running around 300 trillion a year. That's about 25 trillion a month. So if in January you set the rate at 0.27%, which should generate 68 billion in every month. But let's suppose that the transactions drop because of the tax, then we just increase the rate a bit. If transactions increased because the economy picked up, then you could lower the rates. You would be guaranteed to have just the right minimum amount of tax to cover the government requirements. So the readjustments of this rate could be continuous, exactly like exchange rates. It's not a problem that for business that the rate between the dollar and the euro can vary continuously. You just apply the rate when you make the transaction. it will be the same thing. It's not a real problem as long as these rates are not going up and down by very large amounts. Once the system's in place, you can guarantee that revenue will match expenditure. And I think that's a very sensible way of setting up a tax system, totally unlike the current system where you have to guess what the economy is going to be doing next year when you set the tax rates. So a word about implementation. I think each country will be fixing their own rate to match their particular expenditure levels. So different countries, depending on how much social services they want to provide, would have different values. In every case, the idea that would be that whenever you make a transaction between two partners, 50% of the tax would be paid by the person sending the money and 50% paid by the receiver. I would like to suggest that transfers from tax havens like the Cayman Islands could be zero rated to encourage people to move their money back into the system, whereas transfers to tax havens could be double the rate to discourage moving money offshore. And I think this would encourage companies to repatriate their profits from tax havens. It's said that there's something like tens of trillions of profits which are currently just hidden away in tax havens rather than being used. And my proposition would be that actually any financial transaction that did not go through an authorized and tax channel would be a criminal offense. It would just simply be illegal to do it any other way. So let's take an example. Let's suppose that the German rate was 0.1% and the Greek rate was 0.5% because the Greeks need to pay off their national debt and so on. So if you had a German company wanted to pay 1 million euros to a Greek hotel chain, 50% of 1.1% of the sum would go to the German government, that's 500 euros, and 50% of 0.5% would go to the Greek government, 2,500. So total tax on the transaction would be 3,000 euros, that's 0.3%. Likewise, if a Greek car importer, for instance, wanted to pay a transaction of €1 million to BMW to buy some cars, it would be the same thing. The 50% of the 0.1% would go to the German government, 50% of 0.5% would go to the Greek government. Total transaction tax, €3,000, 0.3% again. So imports and exports are treated equally, but obviously internal transactions within the German economy would be cheaper to do than within the Greek economy, and that's only fair. The Greeks have to pay off their debts. Another idea is that these taxes could be multi-level. You could have one bit of the tax which is used to pay the things at a European level. The EU currently has a budget of 141 billion euros a year, and this is paid for by different countries as a proportion roughly of their GDP. In this case, we could have a component of the FTT automatically adjusted to generate exactly the amount of revenue needed to pay the contributions at the European level for each country. At the national level, of course, we'll be matching, we're using an FTT value that would match the revenue levels for current expenditure, and could also include a component to pay off the national debt, for instance, programmed over 10 years, as I was mentioning in the case of Greece. But you could also have a component of the FTT used for paying regional and local level taxes. So this could be made on the basis of residency. So for instance, I live near Toulouse in southwest France, but my bank account is in Paris. Nevertheless, if I was making transactions in and out of my account, a percentage of that would be going to the local regional government, for instance, here in southwest France.